A 500-room luxury hotel in a major American city costs between $800,000 and $1.5 million per key to build, which means the construction alone runs between $400 million and $750 million before you spend a single dollar on the land, the financing, the pre-opening costs, or the operating capital reserve that every lender requires before they'll fund the first disbursement. That number is not the reason flagship hotels fail. The reason is what happens next. To service the debt on a $600 million hotel construction, you need to generate approximately $45 to $60 million in net operating income every year, depending on the debt structure, the equity contribution, and the capitalization rate the lender used to underwrite the deal. To generate $50 million in net operating income from a 500-room luxury hotel, you need to achieve roughly $350 to $400 in revenue per available room every single night of the year. Not on weekends, not during peak season. Every night of the year, averaged. The top-performing luxury hotels in New York, Chicago, and San Francisco achieve those RevPAR numbers, most of the time, in good years. Before a pandemic, a financial crisis, a competitor opens 2 blocks away, or a convention that used to fill your hotel every March decides to move to Las Vegas. This is the episode where this channel explains exactly why the financial model that produces the most architecturally ambitious hotels in American history is also the financial model most likely to fail, and why the same calculation that causes failure has never once stopped anyone from building another one. Subscribe now, because what follows is the framework that makes every other case file in this archive legible in a way it wasn't before. The construction cost per key in luxury hospitality is the number everyone quotes, and almost nobody unpacks correctly. The $1 million per key figure for a top-tier urban luxury hotel includes hard construction costs, which are the actual steel, concrete, glass, mechanical systems, and labor. It includes soft costs, which are the architecture fees, engineering fees, permitting costs, and the consultants that a hotel of this complexity requires. It includes the furniture, fixtures, and equipment package, which in a 500-room luxury property can easily reach $50,000 to $80,000 per room. And it includes the pre-opening costs, the staff training, the marketing launch, the inventory build-out that a hotel needs to spend before it generates its first dollar of revenue. What it does not include is the land. In Manhattan, the land under a 500-room hotel on a prime block can represent $100 to $200 million of the total project cost before the first foundation is poured. In Chicago, San Francisco, and Miami, land costs are lower, but still material enough that the all-in development cost for a flagship hotel routinely exceeds $1 billion. A $1 billion hotel needs to generate approximately $75 to $90 million in net operating income to service its debt at the coverage ratio that keeps the lender satisfied and the borrower out of default. Here is where the math starts to reveal its actual character. The average luxury hotel in the United States operates at a net operating income margin of approximately 25 to 35% of total revenue. To generate $80 million in net operating income at a 30% margin, you need $267 million in total annual revenue. From a 500-room hotel, $267 million in annual revenue requires an average daily rate of approximately $1,160 per room at 100% occupancy, or $1,825 per room at 80% occupancy, which is what a high-performing luxury hotel actually achieves in a strong market. There are approximately 12 hotels in the United States that consistently achieve average daily rates above $2,500. The financial model that underlies every $1 billion hotel project assumes your hotel will be one of them. Most of them are wrong. The occupancy mathematics of a flagship hotel introduce the second layer of the problem, and it is a layer that the construction cost discussion almost always obscures. A hotel room is the most perishable asset in commercial real estate. An unsold hotel room on Tuesday night is revenue that does not accumulate, cannot be deferred, and cannot be recovered. It is simply gone. This is fundamentally different from an office building, where a vacant floor still represents potential future income from a lease that can be signed next month, or a retail center, where an empty unit can be relet without the prior night's vacancy affecting the economics of the deal. A hotel is running a new revenue cycle every 24 hours, and the consequences of underperformance are immediate and compounding. The demand pattern for urban luxury hotels compounds this problem in a specific way that the stabilized occupancy projections in most hotel feasibility studies systematically understate. Luxury hotel demand in major American cities is concentrated in specific days of the week, specific weeks of the calendar, and specific demand drivers, conventions, corporate travel, leisure travel, and events, whose combined effect produces the annual average occupancy that the financial model requires, but whose individual volatility is far higher than the average suggests. A hotel that averages 80% occupancy across a full year may be running at 95% occupancy on Thursday nights in October and 45% occupancy on Sunday nights in January. The average is accurate. The debt service obligation is monthly. The lender does not care about the October Thursday. This is the loop that this channel has documented across every major hotel bankruptcy in its archive, the gap between the annual average performance that a hotel can achieve and the monthly cash flow consistency that the debt service structure requires. The gap is not large in percentage terms. It does not need to be. A 500-room luxury hotel with $600 million in debt at 6% interest carries approximately $36 million in annual interest alone, plus amortization. A 5% underperformance in RevPAR against the stabilized projection, 5%, can reduce net operating income by $8 to $12 million per year. That is not a crisis in isolation. It is a covenant breach in the context of a debt service coverage ratio that was already calibrated to within a 15 to 20% cushion above the minimum. And that is before the competition opens its doors. The competitive dynamics of the luxury hotel market introduce a third layer that the feasibility study's market analysis consistently underprices, and it does so for a structural reason that is embedded in how hotel market studies are commissioned and how the consultants who produce them are compensated. A hotel market study projects the competitive set as it exists at the time the study is conducted. It acknowledges planned and announced competitors. It does not project competitors that have not yet been announced, which means every hotel market study in history has been produced in a market that appeared less competitive than the market that actually existed by the time the hotel opened. The luxury hotel development cycle runs approximately 3 to 5 years from groundbreaking to opening. In that window, every other developer in the market is running their own feasibility study against the same competitive set, reaching the same conclusion about the same RevPAR opportunity, and breaking ground on the same hotel. In New York, the decade following the 2008 financial crisis saw approximately 15,000 new hotel rooms added to the Manhattan market, the majority of them in the luxury and upper upscale segments, in a development cycle driven by the same RevPAR data that had told every developer simultaneously that Manhattan luxury hotels were underbuilt. They were underbuilt in 2010. They were not underbuilt in 2016. The financial models for the hotels that opened in 2015 and 2016 had been written in 2011 and 2012, before most of the competing supply had been announced. If you are subscribing to this channel for the first time, this is why. This is the framework behind every hotel case file you're about to watch, and every developer who built the hotels this channel has documented was looking at the same data and reaching the same conclusion before the market told them they were wrong. The Fontainebleau Las Vegas, documented in the next case file, is the most extreme version of what happens when the flagship hotel economic model fails not in operation, but during construction, before the hotel has generated a single dollar of revenue. At the moment when the construction loan's continued disbursement depends on a credit market that has just ceased to exist. The Broadmoor in Colorado Springs and the Greenbrier in West Virginia are the documented exceptions, the hotels that have survived the flagship economic model's fundamental tension between construction cost and serviceable cash flow through specific structural advantages that the model itself cannot replicate. The difference between the failures and the survivors is not the quality of the hotels or the intelligence of the developers. The difference is in the specific ownership structure, debt structure, and demand base that each property entered the model with. And in most cases, those differences were established at inception, decades before any financial crisis tested them. The flagship hotel economic model does not fail because developers are reckless. It fails because the math at the intersection of construction cost, debt service, and demand volatility produces a range of outcomes that is far wider than the stabilized projection suggests in an asset class where the downside scenario eliminates the equity before anyone has time to respond. Every hotel in this channel's archive was built by someone who had run the same model and found a projection they could believe. The model was not wrong about what was possible. It was wrong about what was probable. Subscribe now because the next 7 case files are the proof. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout.